What is a PE ratio, and how can you tell if a stock is expensive?
A PE ratio is a price to earnings ratio, where we take the price of a stock and divide it by its earnings. The ratio partly tells you if the price is too high or too low for how much it actually makes. It tells you how much investors are willing to pay for $1 of the company's earnings. And remember, earnings or profits here is just what's left over after all expenses have been taken out of a company's revenue. And with a PE ratio, we look at the price and earnings on a per share basis. For example, if a company's stock price is $50 and it earns $5 per share, the PE ratio is 10. That means the investors are paying $10 for every $1 of earnings the company makes. Therefore, when you compare between two companies, it is not the price that determines whether a company is expensive or not. You have to take into account the earnings as well as other factors as well. Let's look at two examples. Company A here has a price of $50 and an earnings of $5 per share. Company B here has a stock price of $100 and an earnings per share of $20. Now, company B having a higher stock price doesn't mean it's more expensive. You have to look at the PE ratio here. The PE ratio for company A is 10 and for company B is 5. In this case, if you use the PE ratios alone, this means company B is actually cheaper in valuation. However, reality is not always this simple. A company's price tends to bake into investors' expectations of a stock as well. So in our example, perhaps company A is a tech company and investors expect earnings to go up a lot more. For example, from $5 to $25. While for company B, investors might expect earnings to remain the same at $20, making its PE ratio still the same. Now, the actual PE ratio based on expected earnings or forward PE ratio will be 2 for company A and 5 for company B, meaning now it's reversed. Company B is actually the more expensive one in this case. So as you can see, a normal PE ratio is not always sufficient for valuation purposes. At the same time, forward PE ratio is what we just used here, are also not always the most reliable ones as well, since people tend to give exaggerated expectations during a bull and bear market.
This is why the greatest investors of all time, like Warren Buffett and Benjamin Graham, usually shy away from expectations and speculations. They focus on past data since they have already happened and are not susceptible to market's sentiment. They emphasize on margins of safety where they buy companies for less than their worth based on conservative existing figures.